Hey, thanks, Regina, and good morning, everyone. I'm Edward Marshall, Global Head of Family Office here at the firm. I'd like to welcome all of you to our latest webinar in our Family Office Intel series. This one is going to be focused on exit planning for business owners. We'll concentrate on the 4 common pitfalls that business owners often experience when they're contemplating a sale of their business. As you can imagine, this is a topic of perennial interest and often fraught with complexity. We hope that you walk away today with some unique insights and some practical advice when looking at making these types of decisions. As Regina mentioned, a little bit of housekeeping. We'll take questions at the end. Please submit them in the chat and we'll certainly get to those. And thank you for that and your participation. It's a pleasure of mine to host a panel of my distinguished colleagues today to dive into the key areas on the planning side when exiting a business. So let's start with some quick introductions. My partners today represent diverse experiences in working with entrepreneurs, business owners, and family offices. Chris, let's get started with you. Chris, give us a little bit of your background, please.
Sure. Thanks, Eddie. Again, my name is Chris Rose. I have our group in Europe on the family office side. As you can tell by my accent, I'm an American lawyer, but I've lived overseas for the last 20 years in England and advising clients globally, primarily on fundraising for family and entrepreneurial-led businesses, all the way through the exit process.
Thanks, Chris. Mike Silverman, over to you for a little bit of your background as well.
Good morning. I'm Mike Silverman. I'm a shareholder at Dentons Cohn & Grigsby in Pittsburgh. And after law school, I got a master's in tax law from New York University Law School. And I did not choose to become either a pure tax lawyer or pure estate planning lawyer. I chose instead to follow my passion and work with closely held businesses and their owners. I've practiced now for 31 years, and I work with closely held businesses throughout the life cycle of a business. I help the businesses and their owners to grow by attracting key employees, attracting investment capital, and helping them to acquire synergistic or competing businesses, and ultimately helping them with their exit and succession plan. I became a certified exit planning advisor in 2010, and since then I've probably drafted well over 100 exit and succession plans.
Excellent. Thanks, Mike. Kelly Wyckoff, let's get a bit of your background and experience of working with family businesses.
Hi, I'm a partner in the Dentons Kansas City office. I primarily work in tax with a little bit of a side practice in charities. My tax practice is primarily in the transactional area with a really specific focus on mergers and acquisitions and tax planning, just strategies for being very tax efficient, I will say. My charities practice is primarily related to the formation of nonprofit 501c3s, public charities, and private foundations. And that actually, there is sometimes an overlap there when people are exiting their for-profit business and have a desire and an interest in forming a charity, often a family foundation, to do some charitable work going forward to occupy their time.
Thanks, Kelly. And Matt Clark, give us some background on your experience of working with family businesses as well.
Thanks, Eddie. So Matt Clark, I'm in the Pittsburgh office. I'm also a co-chair of the national corporate practice for Dentons in the US. So my background, I worked in-house for 11 years, but my practice, I work with entrepreneurs and really through the life cycle of a business from formation all the way through exit. Mike and I work together closely on exit and succession planning. And a big part of my practice is mergers and acquisitions.
Great, thanks, Matt. And then, as I mentioned before, this webinar was going to focus on the 4 common pitfalls that business owners experience when they look at a sale of their business. And those 4 areas are designing flexible and robust exit and succession plans, properly evaluating a business, building a financial plan and a trust and estate strategy, and clearly communicating that plan with stakeholders and employees. So we'll cover that and more on today's session, but let's get started. Mike, let's get started with some definitions on your end. Business owners and professional advisors often regularly use the terms exit planning and succession planning interchangeably. Can you help us with some definitions and understand why those distinctions are important?
Yeah, I think that's correct, Eddie. Just about every new client that I get, I want them to do both their exit plan and their succession plan, and they assume at the outset that those terms are redundant and they're completely different from one another. An exit plan is the structure and plan by which a business owner is going to exit from his or her business. A sale to a third party, a sale to the management team, or an ESOP, giving the business to giving the business to family members, for example. The key with exit planning is every business owner needs to recognize that he or she's going to exit from his or her business either voluntarily or involuntarily, and we need to plan for both scenarios. The reason that it's time sensitive to get your exit planning done is we don't know whether an involuntary event, such as the business owner being hit by a bus tomorrow, is going to happen tomorrow, or whether the exit is going to be a voluntary one that happens in the distant future. So we need to put in place today a well-conceived exit plan that it ensures that regardless of when and how the exit plan occurs, we have a very seamless transition of the business at the maximum possible value that's tax efficient, et cetera. Succession planning, as I said before, is completely different. The succession planning is when we go through a succession planning exercise, we need to identify who the key employees are today that are running and managing the business, the most important employees, and then we have to figure out who's going to succeed them. Is that going to be internally so that we can train and delegate duties to internal people that are running the business, or are we going to have to recruit people from the outside to be the successors in a business? One of the things that pops up again and again and again when we do a succession plan is that we find that the business is totally dependent on the owner. A high percentage of the revenue and the income is dependent on the owner, and we, as part of the succession planning exercise, we need to break that dependency. So we need to get the owner to release the reins and have the duties of running the business flow down to the key employees and the other employees in the business, so the business can run seamlessly with or without the owner present.
Eddie, do you mind if I jump in there?
Please.
So what Mike and I have found working with entrepreneurs is they like to be the lead. They want to tell people the business is an extension of their personality. It's an extension of them. And so the downside of that is they want the business, many of them, to be dependent and viewed as I am the business, because in their mind they are. And in many cases, that is true. But for exit planning and succession planning, particularly as part of a transaction, a buyer does not want to see that or hear that. They want to know that it's a plug and play for the future. And so that's something that has to be kind of reviewed with the business owner or owners over time, that it's important that they set it up that a new party, a new buyer, or that their management team can come in and take over and run the business seamlessly without there being a hit to profits or earnings, because that would be a reduction in the purchase price. And it hurts the future value of the business. I don't know if Chris and Mike, you've seen that, or Kelly as well, but we've seen that as a consistent point of making sure we educate our clients about that and the importance of that.
Yeah, I listen, I think, Matt, that's a great point. And I think it also goes back to what Mike talked about in terms of the voluntary decision to exit a business. So Chris, your thoughts on that in terms of when is it, how does a business owner know when it's the right time to sell their business?
Yeah, leading on from what Mike and Matt said, really it comes down to the underlying motivation. What's driving their desire to sell? Is it liquidity needs? For most business owners, this represents their largest single asset. Or is it succession needs? Maybe there's no one in the family to take over the reins, and so that will dictate the timing here. It may be competitive pressures in your industry, capital needs. It could be health. I think whatever that motivation is ties into the timing of what your decision will be. And you need to balance these personal and business interests together with the existing market conditions, because just because when you're ready, the market may not be ready. For example, it may be a tight credit market and maybe it won't be an optimal sales price. Therefore, business owners need to be a bit opportunistic when it comes to choosing the timing with which to sell, and to give enough time to prepare the business for sale. If you have a magic wand and all things being equal, you'd have 2 to 3 years to prepare your company. But again, if something sudden like health or another reason that you have to sell more quickly, that may change the timing altogether.
So Matt, I think an interesting area there that Chris brought up is that planning and the timing piece. Certainly an area that we've all talked about is making sure you have flexibility put into a plan that's there. But how do you work with business owners, and how have you seen this done well, where you can balance that flexibility with also the incredible amount of consideration that goes into all the different elements that people need to do and accomplish in order to achieve their goals, especially when they're running their business as on a daily basis?
Well, Eddie, I think there's a couple things. I know that we had put out some materials about the kind of 14 points of exit and succession plans, but from my perspective, this ties into 2 key areas. One is the due diligence of the owner's business. When we start with a client, we like to say, we need to go back and perform due diligence on your business to understand, like, the stress test effectively, and make sure that your business is squeaky clean, that we understand all of the issues that face your business, the strengths, the weaknesses, the opportunities. And then we need to tie that into what are the goals and the concerns of the business owner. Are they looking, and that might be different, and understanding that that's different for maybe an early stage venture technology business that's looking to bring in venture capital versus a family-owned business that's in its 3rd generation. Those are 2 different businesses that have 2 different exit strategies, that have 2 different concerns of the owners. And so we need to go back and then identify those every year. The issue is the market changes, as Chris said. That business might change. The family business that's been run for 3 generations might not have anybody there in the family that wants to continue to run the business. And so those are items that we need to make sure that we plan the contingency plans for, but also provide enough flexibility to allow them to continue to have the right people in place for succession or an exit. And again, that their business, their corporate governance, their intellectual property, all of their legal, and also their other advisors are brought in to help on that planning. And again, it's a living, breathing document, these exit and succession plans. They need to be reviewed on a regular basis because things change. 5 years ago is not the same as today. And it's that building that relationship with the owners to make sure that they understand we're here to help them.
Thanks, Matt. And Chris, let's move on to the second pitfall and potential area for concern, and that's really around valuation.
Sure.
Certainly a common area of concern, but how have you worked with clients, and have you seen business owners do this well, of getting the type of valuation that they want, and then also getting their house in order before a sale?
Sure. I think Matt touched upon this already a little bit. Key element of creating buyer interest and realizing, potentially high valuation is the ability to articulate the company's future growth strategy and prospects. So in other words, it's a sales process. What you tell them, you have to create credibility in what you're saying. This may be through creating a near-term budget and longer-term financial forecasts, all tied into a very credible business plan. And being able to articulate that vision properly and position yourself for these prospective buyers. But it's also, as you say, a bit of cleanup as well. I mean, you have to look at it from a buyer's perspective, primarily as if you were not going to be in the business, this plug and play analogy that was used. and then look at the deficiencies with objectively in your own business. And often we encourage business owners to do a vendor due diligence, even if it's an informal one, to look at for example, their financials. Are they audited? Are they audited by a reputable high-end auditing firm, or is it just a local firm? That makes a big difference. A lot of buyers, particularly public companies, will only accept audited financials. Again, that's a credibility issue. Looking at your management team. Again, you're not going to be in this business, so you'll have a diminished role. So going forward, do you have any holes in your management team that need to be filled prior to a sale process beginning? Again, your financial advisor will help inform you on those decisions. Then moving on from that, your books and records. Again, Matt touched on this. If a key aspect of your business are your customer relationships, are all your material contracts with customers buttoned up? Have they been reviewed by legal counsel? Do you have any unusual or contingent liabilities? Again, for example, environmental exposure or employee litigation. Again, address those prior to the sale process. And then, of course, intellectual property. This is where we often see it, especially in technology-driven companies, which I work with. There's often a lot of sloppiness that comes in as we operate these businesses where we don't button down all, the ownership of the IP, and that can delay or a process or even potentially reduce a valuation if intellectual property is a key aspect.
So on top of IP, Mike, what are some of those other areas that you look at when you're trying to think of how to help business owners make sure that their business is actually transferable?
Well, as I mentioned before, the revenue and income of a business do not create or represent value if they're totally dependent on the owner. So we have to eliminate any owner dependency issue that we might have. The other thing that I think is critical is that the business owner has two reference points. Typically, the business is 90% of that business owner's net worth, and so I want the business owner to see in the bright lights what's the value of my business today. What are the net proceeds that I could get from the sale of my business today based on that value after taxes and after professional fees and whatnot? And let's take that reference point and compare it to the number that the financial planner for the entrepreneur is telling him or her is the number, the amount of money you need for your retirement. In general, there's always a big delta between those two numbers. Today's after-tax net proceeds from a sale versus the number you need for retirement. And what that puts into play is growth planning. How are we going to fill in this gap so we can increase the value of the business so that we can meet the amount of money you need with this asset that's 90% of your net worth, so that you can go off into your retirement successfully with a successful exit.
Kelly, putting your tax hat on, what are some of the areas that you've seen that are important for people to take in consideration?
Yeah, kind of circling back to a lot of the things that Chris and Matt were saying, like clean house before you go out for bid or some sort of exit strategy. I've seen a lot of renegotiations of purchase price when the tax compliance wasn't quite there. And a lot of times the big issues that we often will run into are state and local income and sales tax non-compliance. A lot of that comes into play when a business isn't paying attention to they're operating as they have in the past and aren't paying attention to changes in tax laws at the state level, whereas states used to look at physical presence to determine whether you're supposed to be paying sales tax or income taxes. A lot of them have moved to the sort of economic nexus standard, where do you have enough sales into or enough revenue being generated from a particular state, and now you're subject to tax. So we've run into a lot of issues there. Other areas that you'll run into that, and they create big tax liabilities pretty quickly, particularly in sales tax, because it's not tied to whether you are or aren't making taxable income in a particular year. It's really based on your revenues. Other areas where, you can have pretty big tax liabilities and give a buyer some pause would be treating employees as independent contractors. That happens a fair amount. A little bit of tax savings on the front end can be a big problem when we're negotiating a purchase price on the back end. And then the other area where we'll often run into an issue would be if you have an S corporation. S corporations are really have we realize in the tax area, they're really difficult for people to comply with all the rules and requirements. It's just one little misstep and you can blow your S corporation status. And in some cases, it's easy to get back in compliance. Other times it is not, and that'll give a buyer a lot of pause as well. So those would be the three areas. I think just general rule, do some due diligence in the tax area. Make sure you've got a clean house in that respect.
Thanks, Kelly. Chris, when you're trying to think of the ideal buyer, the best buyer, how do you find out what that person is, what that looks like, whether this theoretical best buyer, and how does that impact the sales process of clients that you've worked with?
Sure. I think it's first about understanding the three broad categories of potential buyer. You're talking about strategics, financial buyers, and management or through an MBO of some sort. Let's start with strategics. Again, first of all, I mean, stepping back again, you heard me talk about motivation to sell earlier. This comes into play here now, as well as your values as a seller, whether you value maximizing the valuation or the cash proceeds, or if there are other areas which are concerned to you, including your management team. Will they stay on with the business, your employees, your facilities? And so taking these into account will help you position and identify what your potential better buyer is and where the fit is. Looking at these three categories, let's start with strategic. I mean, when we say strategic, we mean typically companies in your industries. These are other corporate buyers, potentially competitors of yours right now in your marketplace, or it may be suppliers or customers in the vertical integration of your industry. Here, these types of buyers, the pros really are they will generally pay a higher purchase price if you fit into what their needs are. If there's synergies, maybe you have a product, maybe you have intellectual property, customers, or maybe they're in another market coming into yours. They'll often pay more than other buyers, and often that is a plus. And oftentimes these transactions will close more quickly. They understand your business. Due diligence process is probably going to be faster. That being said, some of the drawbacks are they probably will consolidate. They probably will, there'll be redundancies with management and employees and facilities, and so that may, that may be something to take into account depending on your situation. I think another thing is, for every buyer's, where does he see his or her life? Where do they see their lives after the acquisition? If you sell to a strategic, it's probably going to be a complete exit and maybe a short consulting period before you walk away. Now let's move to a financial buyer. Now it's a somewhat different approach. They're more opportunistic. They're looking at your business as undervalued. They'll leverage it potentially in the acquisition, but they'll want you to probably stay on for a period of years and keep some skin in the game. Now that can be great for a seller that feels that he's leaving money on the table and wants a piece of the upside going forward. But for another seller who may be on the verge of retirement, maybe, they don't want to stick around for those few years. Again, in contrast to a strategic buyer, typically, they're looking for a strong management team who will remain in place. So that's good for your people. But with the leverage, and they may have deep pockets to do bolt-on acquisitions going forward, which may create more value. But I think, if you're a person who's been running your business as you've wanted to run it all these years, to now post-acquisition really answer to other people and have to focus on real KPIs and targets that you're held personally accountable for, maybe a different lifestyle. The last category, of course, is management. And it can often sound great to an owner of a business to sell to the next generation. The people help you build it. The question is, do they have the money to buy it? Will they financing, and if so, there's someone else to answer to. And more than likely, we might go back to step 2 of a financial buyer who will support this management team in this sale. So, I mean, you see pros and cons in each. Ultimately, you have to ask yourself what's important to you, and also whether your business is better suited to be acquired by someone in the industry, or maybe you just don't want to sell to a competitor because you're concerned about even the process of disclosing information to a competitor during the sale process, which may be very emotionally for a lot of our clients. It's just a tough thing to understand to sell to the person down the street. So I think you have to weigh all those interests. I'm sure my partners in the call have more to add to this one.
Chris, I agree with you. I think that a lot of it is we talk about the plan and going back to the exit and succession planning. One of the things that we found is that on some of the strategics, that they're not looking to sell, but a strategic buyer approaches the client and says, we have this great opportunity, here's an offer, and they're not prepared for it. And so that's what we're trying to make sure, that they're prepared for that offer, that it's not, as Mike had alluded to and stated earlier, it's not always on your time frame. And so what happens if that strategic buyer or even a financial buyer approaches you with this great opportunity? Are you ready? Do you know what your number is in order for you to walk away from the business? Because my experience, I think, Chris, is much like yours, and that is an entrepreneur or a business owner who's run their business for multiple years to now become, as part of a strategic management and take direction from somebody else. That's a really difficult process, and usually they're only around for a couple of years. And does that number that they're looking at, does that work for them, rather than planning, well, I'm going to stay with this new combined business for 6 to 8 or 10 years. So it all kind of goes into the equation of whether or not it's the right time to exit.
So thanks, Matt. And so folks have made that, looked at the equation, have done the math, and they decided that they want to go through the process. Chris, are there some specific considerations and provisions that people should be looking at through, in their shareholders agreement or any other types of documents that could be material to a sale, other than the due diligence areas that we've talked about before?
Sure. I think really the bigger picture here is what other stakeholders are involved in this process? Who else do you need to get buy-in from? This may be other shareholders, and maybe your family. In the context of other shareholders, I mean, if you are not the sole shareholder and you should look at your shareholders agreement. Again, if you want to know, at least if you're in a position to compel other shareholders to sell alongside you, should you see an offer you want to accept. And you frequently see what's called a drag along provision in these agreements. You should have, at least as you're preparing the process for sale, you should familiarize yourself and have your lawyer take a closer look at these provisions to understand whether you need another shareholder approval to drag, whether there's minimum thresholds like IRR, and anything else that may get in the way of a potential sale. It's better to know this sooner than later. But really, it's just understanding where you are at with your constituents and understanding that and try to get alignment ahead of a sale process.
Let's move on to the third area that we mentioned as a potential concern for business owners and entrepreneurs in this space, and it's really around building a financial plan and a trust and estate strategy. Mike, you and Matt often talk about the 5 Ds when you're looking at a sale. What are those 5 Ds, and then how can you keep them in mind as you're trying to put together these financial plans and the trust and estate strategy for a family?
Well, the 5 Ds are death, divorce, disability, distress, and disagreement. And exit and succession planners refer to those 5 Ds as the Pareto horribles, because any one of those things can completely bring down the value of a business. A career's worth of work and building a value of a business to a certain point can all get wiped out by an owner getting hit by a bus, by a divorce. We've seen all 5 of them wipe out the value of a business. And so the planning we really need to do around that is twofold. We need to do contingency planning, because we need to, in the event of disability or death, we need to have life insurance or disability insurance in place. The life insurance, with regard to a key employee, we get life insurance proceeds in so we can shore up our situation. We can go out and recruit key employees to replace the person who's no longer there. Same thing with disability insurance. So life insurance is also extremely important in terms of a buyout. The last thing I would ever want one of my clients to do is have to impair their balance sheet with a big promissory note to buy out an owner's stock following the death of that owner. So I want life insurance to fund that and to us to pay the premiums all along. The other thing that Chris and Matt have alluded to is you have to have a really well-drawn shareholder agreement or partnership agreement, as the case may be, because the four corners of that agreement have to address every contingency that you can have at the owner level or the business entity level. And so that includes, divorce and bankruptcy and termination of employment, disability, et cetera. So we have mechanisms in those agreements to address all those contingent events.
So Kelly, piggybacking on what Mike said in terms of contingencies and other types of strategies, what have you seen from your perspective as, some effective legal and even non-legal strategies that business owners can take in consideration when they're looking at all of the different planning options that are out there, whether it's charity, 419A issues, state tax issues, goodwill, all these things that come up in the work that you do quite often?
Yeah. I think that, as probably heard too many tax attorneys will say, well, it's all very fact specific as to what the tax implications are. But, our goal is always to do something that's in a tax efficient manner, but accomplishes the bigger picture goals. I think a lot of it depends on who is taking over the business. If you have a third party buyer, that creates a much different situation than if your management team is buying in or they're being given granted equity. When you're dealing with a third party investor or buyer, you're usually trying to do things in a manner that maximizes cash in a lot of situations, so decreases your tax as much as possible. When you're dealing with, and in some cases, maybe that part of that is that you're receiving equity in a tax-free rollover of equity of the buyer that you can later, defer the tax on by selling at a later point, or maybe there's an exit event for that buyer, depending on how that's structured. When you're dealing with management team taking over, there's a lot of, or family, there's a lot of issues with management in terms of you've got to structure it in a manner that is efficient, because compensation, when you're having a management takeover, if you're gifting it, which really isn't a gift, when they're working for you, you've got ordinary income tax rates for them that you're dealing with. You also have, with family, you've got to take into account your estate and your gift tax. And so it really, again, just depends greatly on what your buyer is, who your buyer is, or who the succession plan and what that entails. One effective thing that I've seen, or I shouldn't say effective, I think it's more in terms of it comes into when your seller is thinking about what they want to do after the sale or after their exit from the business. A lot of times they do want to do charities. I alluded to this earlier. They have charitable intentions, whether it's a legacy for the family. There's some tax savings to be had there. So they'll set up a private, I'll mention this, I've had a lot of them set up private foundations, and equity will be gifted or donated to the private foundation. And then you've got some, that's a tax savings measure. Plus you have a charitable legacy that you created for you and or your family. But I think I'll leave you on this point, key planning tax aspect is please involve your tax advisors prior to signing an LOI. There's a lot of things that are more difficult to reverse after the LOI, and we may not capture some of the desired tax planning options.
Thanks, Kelly. And then Matt, maybe to cap off this piece, is we've talked about a couple of alternative strategies, maybe some, not the typical strategies that people say, I have a business, I'm going to sell to a third party. What are some of, are there any other areas that you'd like to talk about, and maybe the pros and cons of going down some of those paths?
Yeah, the one, probably the hot area, and actually I might call on my colleague, Mike, to talk about it, but we've noticed is you have kind of the management buyout that Chris discussed, but there's also ESOPs. And so selling either a part of the company or all of the company into an ESOP can be really a tax advantageous structure. It provides some more flexibility for the owner. There are some cons related to the expense, but we think in many cases the tax benefits outweigh those cons. I don't know, Mike, if you have some thoughts on ESOPs. We're seeing more and more of those in the marketplace right now.
I think in the first, uh, 30 years of my career, I only worked on a handful of ESOPs, but in the past 2 years, I've probably worked on as many as 6 or 7 of them. There are just so many different tools that you can avail yourselves of by considering an ESOP. Everything from the owner being able to sell on a tax deferred basis his or her shares to an ESOP and rolling the proceeds into the stock market and deferring his or her gains, to having the employees participate at the ESOP level so that they're involved in the exit plan and they're benefiting at the ESOP level, to having an S corporation owned entirely by an ESOP and having all the income flow into a tax exempt vehicle so that the income of the S corporation is no longer subject to tax. So there's a lot of tools that we have at our disposal in considering an ESOP with an exit plan.
Well, thanks, Mike and Matt, for that piece. And before we move into the last section, I just wanted to thank folks that have put in questions into the Q&A and the chat box. If you have any more, do get those questions in, because we'll jump into those after this part right here. So, Mike, with that, let's talk about something that I think is a theme that has come up during the entire conversation, is looking at communication and motivations when families are looking to sell a business, or entrepreneurs are looking to sell a business. How do you do it right? How do you get that communication down right with all the different kinds of shareholders and stakeholders, I should say, and employees? Have you seen anybody do it well, and some areas where you would recommend people try to avoid?
Well, I think there's 2 concepts that you have to coach them, you as a practitioner, whether you're a lawyer, an accountant, financial planner, whatever. The first is that their perception is that the exit plan and succession plan is all about the owner, and that's not the way it works. Because with every business, there are stakeholders in that business. The stakeholders are the owners for sure, but also the key employees. And the key employees need to have transparency, because they want to understand the owner's exit. They want to understand their own exit from the business. They want to see what the future holds for them. So when we do an exit plan, we do it as a roundtable. So those key employees are at the round table with the owner, and we're developing an exit plan that's unique to the owner and his or her ownership interest in the company. But we're also considering how are we going to motivate the employees to get them incented to grow the value of the business, so they have clarity on what lies ahead for them. And what we typically do is we implement some type of incentive compensation plan. Very atypically, we'll actually grant stock to them as their exit. But what we'll do more frequently is we'll give them an interest in a stock appreciation rights plan, where they benefit from the appreciation of the business in the future, or a phantom stock plan where they benefit from the totality of the value of the business. What we do is we put it on a long vesting schedule, so they're contributing a lot of sweat equity that's in tandem with the time frame for the owner's exit from the business. And we button down the goodwill, as Matt had alluded to earlier, by subjecting them to an employment agreement that has non-compete, non-solicitation, and whatnot. So they're getting locked down with some restrictive covenants, but they're benefiting tremendously, and they're very motivated, and they're rowing the same direction, the oars, as the owner. The other problem we have is just procrastination. Every client I get, when I get them as a client, I say, we got to do your exit and succession plan right now. Time is of the essence. And they'll just say, I have bigger fish to fry in my business. I really will do this at a later date. It's not late. Nothing's happened. And I highlight for them that, again, 90% of your net worth that you build up over so many years in your career is embedded in this company. And you could get hit by a bus tomorrow with no plan in place, and all of that value disappears. So I'm a big fan of the expression, yesterday is history, tomorrow's a mystery, today is a gift, and that's why it's called the present. So let's define the future and bring it into the present, and do planning around it. And so those are the 2 hurdles, motivation and understanding for the business owner that they're not the only one that's included in the exit plan.
Wow, I like that, Mike. Certainly in terms of the busyness of all these business owners and entrepreneurs is a common factor in getting things from there. Chris, any additional thoughts?
Yeah, I just want to say, I mentioned earlier that a big part of what I do is advising early stage companies and investors in these companies. And it's funny how it's so much different. At that stage, we always talk about, investors bet on jockeys, not horses. It's all about the founders, right? And at a certain point, as a company matures, we founders keep that in their heads. Families keep this in their heads. It's about me and building this, and it's about my show. And when you're getting to exit, you got to flip that. You have to be dispensable. You have to look at this as not your business anymore, but an asset that you will eventually sell. And what will it look like without you? And I think it's very hard for a lot of entrepreneurs to separate themselves from that. But if you have to prepare for exit, you're already behind the eight ball, as Matt indicated. You have to be in a constant state of readiness. And I think that because as Mike said earlier too, you don't know when it's going to happen. So you've got to take yourself out of this process. And I think if anyone takes anything away from this seminar is don't wait till the time you're exiting. Start thinking now about how to get yourself out of your own business and allow it to function without you, with a strong management team, and look at it from the outside if someone looking in. And that is really a game changer and a change in mindset.
I like that. I like that perspective of seeing it from an outsider's position, right? So getting an outside point of view on that. Matt, did you have any additional thoughts on there? I saw your hand move, so
No, I agree. So Mike and I have had examples on both sides of the spectrum. One was a client who had procrastinated, said they'd get to it, and they had an unfortunate event. The client had a heart attack, passed away, and the business was left to the client's wife. And it really resulted in a fire sale. That was one example where you can push the client, but ultimately it's their choice. And then we had another client, two owners who really took it to heart. They set up a business and set it up correctly from the beginning, understanding that they wanted an exit. They were not in it for the long run. They put a plan in place. They made sure the business could operate without them. They literally were telling Mike and I that they were bored running the business at that point because they were at home watching TV most of the day. They had an exit within 5 years, and it was a significant exit. Again, it was the right market at the right time, but they were ready based on the exit plan to take advantage of it. And so it makes a difference. It really does. And we talked about it earlier. It's making sure that the owners see that and it's institutionalized. Just like they file their taxes annually, you need to look at your exit and succession planning annually.
Okay, so last question for all of our panelists is lessons learned. If you had to pick one thing that you had wished you had known when you'd started working with families in this space and entrepreneurs, what would it be? Mike, let's start with you.
I think that it would be when I was a younger lawyer, I always thought that nirvana was to have a business owner sell his or her business to a third party buyer. And over time, I've recognized, as Matt alluded to earlier, there are a lot of pitfalls in third party sales. Everything from the representations and warranties, the indemnities, the professional fee costs. And since then, I've done a tremendous high percentage of my exit plans as internal transactions, where the owner is selling without the burdens that I just described, the business to the management team, either directly or indirectly through different structures we use. So I wish I had known it long ago, but those structures are so much more efficient, so much more predictable, and so much more to the net pocket of the client by engaging in that structure instead.
Thanks, Mike. Chris?
Sure. I've even been involved in this personally. I think a lot of family businesses refuse to believe that the next generation will not take up the helm. I'm saying this the wrong way. They assume the next generation will take up the helm, and they refuse to believe otherwise until potentially it's too late, and they don't consider any other options, nor do they plan accordingly. And I think that is a problem I constantly see, and it's very hard to change those views. And I think hopefully seminars like this do that. But that's what I would take away from that.
Kelly, what's your lesson learned?
I think my lesson learned would be to not only focus on the short term, for me, tax planning, but also focus on the long-term tax planning. I see a lot of clients who have put themselves in a situation to where, the short-term, like the day-to-day tax implications of their operations are well taken care of, but we get to an exit event and there's an opportunity for, let's say, a huge tax benefit, and we're just not eligible. And it might be because, you know, the time clock was too short. You started doing X 3 years ago when you should have done it 5 years ago. So I think just, you know, thinking about both the short term and the long term from a tax perspective is really important.
Thanks, Kelly. And then Matt, your lesson learned.
The exit and succession planning is a very emotional process for the owners. It's really about them. It's very personal to the owners, and understanding that for us to sit here, and I recognize I'm saying you should just do this every year. It's more than that. It's a process, and it's making sure that they understand that the outcome is best for them, for all the parties around the table, their families, their employees, the legacy of their business. And that's something that we hear often is my legacy, our legacy. And so that's something that's very emotional, and understanding and appreciating that is something that I think takes a little bit of time that I wish I would have understood coming right out of the gate.
Thanks, Matt. All right, let's open up to questions. First question is about the amount of M&A happening is quite large today. One of the areas that this person is asking about is disagreement about the future of the business, whether or not selling or passing on to the next generation. I think, Chris, you talked about this already, about having to make that decision. Should you sell the business, or should you find a way to transfer it to the next generation? Where have you seen some good ways to talk to family members about making that tough decision?
Well, I think again, not all families are the same. I mean, when you're talking about multi-generational families, ideally they would have some sort of charter in place that helps dictate the future of arrangements, including of the family business. But again, it's starting these conversations earlier than later, and identifying whether succession is likely within the family or not, and if not, and if you want to continue to maintain this business, whether in selling it, is to bring in professional management and help support that management in growing the business.
Thanks. Any other thoughts or on kind of managing that process from Mike, Kelly, or Matt? Okay, so the next question is really, I think, comes back to you, Matt, in terms of the non-financial, the non-legal, the emotional side of making that transition, and it's not, or making the sale. What about life after an exit? How have you dealt and worked with families and your clients on how to plan out what's going to happen for them next, especially if they've built that business over a long period of time?
Yeah, I think one, it's the discussion all along of how do you see your life after? One, it's part of the financial plan. Do you think you're going to want to get back into the business? What are your plans with your families? And then the one big item that I talk to business owners that are exiting a business is many of them think I'll stay with the business. And I just have not seen that being generally successful. And so it's counseling them. I think you're going to need to find somewhere else to place your energies. And some of them, then it's just kind of working through the process of helping them. Do they want to become an active investor? Do they want to just sit out for a year or two? And then for their non-compete period, there's always going to be a non-compete period. Do they want to go into consulting? What are their passions? And then how can we help them making sure that they are able to consult with other businesses? Do they take on a charitable role? What are their passions and what are their next steps in their lives? It's a discussion.
Yeah. This question is for Chris, but I think could be applicable to a couple other of our panelists as well. What about cross-border? when you're thinking about a sale and a transaction in that manner, or a family outside the United States selling into the United States? What are some of the things that you've done, Chris, that to help people prepare for something like that and to be on the lookout when you're doing cross-border transactions like that?
Sure. I think, most of what I see is cross-border because buyers come from many places, sellers in different places. So I think, the States is such a large market that you naturally assume you're going to get a domestic buyer, but especially when you're in Europe, you're assuming it's going to be a buyer from another jurisdiction. And I think it's casting that net large and wide to understand where the best fit is with those potential buyers. In terms of structuring, though, it's not that much different than what we were talking about here. Maybe not with respect to the ESOP, but the options are still on the table here, whether you're looking at a financial buyer or a strategic buyer. And all the principles we've discussed, remain the same. I do believe. So I don't think they necessarily need to focus anything differently. If wherever you are in the world, there are baby specific tax issues involved, and therefore you should get tax advice in whatever jurisdiction you're in from a personal and a business standpoint. And luckily at Denton's, we have a global platform that can assist you.
A few tax packs for maybe even one on this panel. So last question, Mike, and I think this comes to you, is what happens if there's you're in a condition where it's not ideal, market events, geopolitical events, or whatever it is, but you have to get it, or a death, or one of the 5 Ds that you mentioned, which all of them sound horrible. What do you do to prevent and the downside in situations like that, and try to work through areas when maybe the market's just not right for a transaction?
Well, I think that a lot of it goes to the contingency planning. If you go back to what I said before, that when the client sees in the bright lights the value of his or her business today and the net proceeds he'd get today, and compares that number to the number he or she needs for retirement, there's usually a pretty good chasm between those numbers. And so if an intervening event happens, death or disability or loss of a key employee, we largely it's contingency planning. Largely it's going to be life insurance and disability insurance to shore up the ship, so that if there's a death, then we can fund that. We can fund the buyout with life insurance proceeds, and then we also should have life insurance on key person insurance at the entity level, so that we can use that tool if a key employee got hit by a bus, then we could use that as a sort of a fund from which to recruit other talent. Things like divorce, I mean, that can happen, but what we need to do to protect ourselves in that situation is not be subjected to a divorcing shareholder spouse, so that we have to have in our shareholder agreement, for example, a call right, so that we can purchase that divorcing shareholder shares to prevent having a new owner. But those are some of the examples of what we would try to do to shore up the ship in those types of situations.
Thanks, Mike. And a reminder to our audience is that we do have a new white paper that's on this topic called 14 Tips for Family and Business Owners to Consider as they're going. Goes into a little bit of more depth than we talked about today. Also, everyone on this panel, you'll have their contact information. And please, I do encourage you to reach out to them or any of our other Denton's colleagues if you have questions or on this area. So thank you, Chris, Mike, Kelly, and Matt, for participating today, and thank you to all of you for listening in. If you'd like to get in touch with our speakers, or you have any questions on this area, you can reach out to them directly or hit us up on email at familyoffice@dentons.com. If you'd like to sign up for our newsletters and learn more about our solutions and research in the family office and family business space, do check out our website. That is dentons.com/family office. Well, that's it. Bye, everyone.